Forward contracts. Now, forward contracts are actually a simple derivative. Simple derivative security, and it has something to do with buying or selling an asset in the future at a certain price. So buying or selling an asset in future at a price. The contract are between two parties, and it is not normally traded on an exchange. Now, the forward contracts could be long position or it could be short position. So if you're doing a long position, you're buying, and if you're doing short position, you are actually selling. Now I'm explaining this in a most easy to understand kind of way. If you have any questions, do email us on our website. So let's continue. Then there is a delivery price. That's the price on which the trade will happen on. And there's also a cost, which could be broker cost or payment cost or transaction cost. And then there is a forward contract which is settled at maturity. That means in the future, when the time comes, you will actually pay or receive the money. The holder of the short position delivers the asset of the holder to the long position in return for cash amount that was agreed. A forward contract is worth 0 when it is first entered into. Later it can have a positive or negative value depending on the movement of the price of the asset. For example, if the price of the asset rises after the initiation of the contract, the value of the long position in the forward contract becomes positive, and the value of short position forward becomes negative.